Good morning, students. A pleasant wishes to you all. In this week, we will discuss about the chapter 15, insurance. Okay, va? So this insurance you have heard in your life because sometimes your parents may paying insurance for you. Likewise, but detailly you will understand only from this chapter. Okay. Now let us see the introduction. What is mean by insurance? Insurance, for example, let us take for example, business is exposed to many risks like fire, theft, etc. So this risk can be transferred to a specialized institution that is known as insurance companies. Insurance companies compensate this uncertainty by providing financial compensation to the business whatever is affected. Okay, va? Now let us see the meaning of the insurance. Actually, insurance is a contract between the insured and the insurer, under which the insurer undertakes to compensate the loss arising from the risk insured, provided the insured must pay the premium regularly. Now let us see who is the insured. Insured is a person whose life is taken as risk, or whose property is risk, whose property is taken insurance for the risk arises, and who is known as the insurer. Insurer is a person who compensate the loss arising from the risk insured. He is also known as assurer or undertaker. Now let us see the various definition, that is definition given by John Murch. Actually, insurance is a plan by themselves by which large number of people associate and transfer to the shoulders of all risk that is attached to the individuals. Okay, so ஒருத்தரோட லைஃப்ல வர ரிஸ்கோ இல்ல ப்ராப்பர்ட்டில ஏற்படும் ரிஸ்கோ எல்லாரும் ஷேர் பண்றது தான் இன்சூரன்ஸ்னு சொல்லுவோம். Now let us see the various principles of insurance. Actually, insurance, no, it is based on the principle of cooperation because the risk is shared among the various peoples. So the cooperation is said to be the principle of insurance. Now let us see the various principles of insurance. First one is utmost good faith. Utmost good faith na எப்பவுமே நல்ல எண்ணத்துல தான் இருக்கணும். Next one is insurable interest. Insurable interest means pecuniary interest. That means ஒருத்தரால ஒரு ப்ராப்பர்ட்டினால பணத்தால கண்டிப்பா நஷ்டமோ இல்ல லாபமோ அடைஞ்சிருந்தா அதுதான் நம்ம என்னன்னு சொல்றது pecuniary interestன்னு சொல்றது. ஓகேவா? Next one is indemnity. Third one is indemnity. Actually, indemnity means to make good the actual loss suffered. என்ன நஷ்டம் ஏற்பட்டிருக்கோ அந்த நஷ்டத்தை ஈடு பண்ணு மட்டும் தான் சொல்லணும். Not the excess of the actual loss. ஓகேவா? And the next one is casa proxima. Casa proxima means only the nearest casa. Okay, should be taken into consideration. And the next one is contribution. Contribution means sometimes I'll explain in detail. Contribution by two or more companies, that is known as contribution. And the next one is subrogation. Subrogation means getting into the shoes of another, that is known as subrogation. Now we will discuss about the utmost good faith. Now, first principle is utmost good faith. Now, what is meant by utmost good faith? The main principle of insurance is utmost good faith. That means the insurance contract must be based on the utmost good faith. That means, for example, before entering into the contract, the insurer he has to provide all the informations whatever is required for the terms of the contract. Is it okay, va? And then next one is the insured he has to provide all the, he has to disclose all the material facts relating to the terms of the insurance. In that case, both the insurance and the insurer, that is both the insurer and the assured, must be that is must make the contract based on the principle of utmost good faith. Now let us take one example. Okay, va? For example, Mr. X. Mr. X has insured his shop. Insured his shop, that is the shop is a Now let us see Mr. X. Mr. X has insured his shop. Okay, well, that is the shop is it contains provisional provisions like likewise. Okay, well, so but fire occurs. In that case, the entire stock of the shop is damaged by fire. But the insurance company, does not provide compensation to the X, Mr. X. Why? For what reason? Because the X did not disclose a material fact that during the festival seasons he used to sell the crackers also. So the fire has occurred only because of the crackers burst only. So the insurance company is not under obligation to provide compensation. So this principle of utmost good faith is both the insurer and the assured must disclose all the facts whatever is related to the terms of the contract. So in this case the principle of utmost good faith does not apply. Okay va? Now let us see the second principle, insurable interest. What is meant by this principle of insurable interest is applied only to the property insurance alone. Okay, va? So insurable interest means it should be based on the pecuniary interest. Now, what do you understand by pecuniary interest? Pecuniary interest means suppose if a person must get benefit from the existence of any property, or he must be prejudiced from the destruction of the property. That means suppose ஒரு person வந்து ஒரு property-னால financially he must be benefited, otherwise he must get affected because of the destruction of the property. So this principle of insurance arises only for the property insurance alone. Okay ma? So pecuniary interest must be applied to all the property, that is property insurance. It must be applied at the time when the risk is incurred. So it must be applicable only when the risk arises. This property, that is this principle must be applied. Now let us take the various examples. Now let us take the example. For example, a person must have insurable interest for the property of the building. Okay, that the full value of the property of the building. Because of the building only he earns income. Suppose if he does not earn income, suppose if the building is destructed or damaged, means he will not derive any income from the building. So that is known as insurable interest. Now let us see the next principle, indemnity. Actually, indemnity means make good the actual loss suffered. That means நீ என்ன loss incur ஆயிருக்கோ அதுக்காக மட்டும் compensation கொடுத்தா போதும். That is known as indemnity. It is applied for the property insurance alone. For example, the insured must be placed before a loss in the same position as he was immediately before the loss. That means the insured must not get any profit out of it. That is, he should not derive any income from the risk insured. Suppose in case of total loss means the insurer actually pays only the actual loss, that is or the sum insured, whichever is less. Okay va? So under no circumstance the insured must, that is the insured should not get more than the actual loss incurred. For example, we can take one example of a building. Example we can take, for example, why X an insurer as insured is building worth rupees, the building worth is rupees 6 lakhs. Okay va? And then the X he has taken insurance for the building for rupees 4 lakhs only. Okay va? Insurance is only for 4 lakhs. But sometimes because of some damage happened, because fire occurs, in that case the building is damaged and the actual losses incurred is estimated to be rupees 2 lakh only. In that case the insurance company is liable to pay only 2 lakhs, but not the 4 lakhs for which he has taken insurance. Okay va? Now let us take another example. Suppose if the building was destructed fully, so in that case the actual loss estimated is more than the 4 lakhs. In that case, the insurance company it is under obligation to provide compensation only for the 4 lakhs, not for the worth of rupees 6 lakhs. So in that case, whatever the actual loss incurred or the sum insured, whichever is less, only the insurance company is liable to pay compensation. Okay. Next one, we can see the next principle, causa proxima. Actually, causa proxima means nearest cause. That is not the remote cause to be taken into consideration. Suppose when the result loss is the result of two or more cause, means only the proximate cause must be taken into consideration, not the remote cause. For example, a stock, suppose if the stock is destroyed by fire, okay, so the insurance company first they will analyze what is the reason for the destroy, that is what is the reason for the fire. So after analyzation only they will come into conclusion, because the fire stock is destroyed by fire, not by actual fire, only due to the excessive heat of the power supplies. So the insurance company it is under no obligation to provide compensation to the insured. Next one, we will see about the contribution. Now, what is the meaning for the contribution? Suppose if the same subject matter to be insured with more than one insurer, means that is known as double insurance, we can say. So, in such a case, the insured must be paid compensation by all the insurers in proportion of the sum insured. Suppose in case of multiple insurance, means the insured can claim loss from any one of the insurance company. In that case, the insured cannot get the benefit from more than the two or more insurance companies because of the actual loss. That means all the insurance companies they can contribute together in proportion of the sum insured. Suppose Mr. X he has taken insurance from insurance company A. Okay, insurance company A for rupees 10 lakhs. Okay, and then next he has taken insurance company from B for rupees 5 lakhs. So the insurance of that is some damage has incurred to this stock. In that case, the damage is estimated to rupees 1,50,000. Okay, as he has taken insurance from two or more companies, these two companies can contribute together in the ratio of 2:1. That is, one company may give the compensation as 1 lakh and another company can give the compensation as 50,000. So that is the main principle of contribution. Next principle is subrogation. Actually, subrogation means getting into the shoes of another. That is stepping into the shoes of another only, we can say. For example, the insured has insured any property to the insurance company. In that case, he claimed the insurance. So in that case, after claiming the insurance, he must transfer his rights and remedies to the insurance company. Is it clear? Now let us take one example. Mr. X. Mr. X has insured his car. Okay, so insured his car and Mr. X met an accident which is due to the negligence of Mr. Y. In that case, as Mr. X he has insured his car in the insurance company. He claimed his insurance from the for the damaged property from the insurance company, but he cannot claim Mr. Y for the damaged property, because after claiming the insurance, the entire rights and remedies must be transferred to the insurance company. Sometimes if the insurance company requires, means he may take action against Y for the damage of the property, that is X caused property damage. That is known as subrogation. So subrogation means stepping into the shoes of another. That is transfer of rights and remedies after getting the property insured to the insurance company. Now let us see the topic life insurance. Actually, life insurance means it is a type of contract between the insurer and the assured, under which the insurer compensate the loss arising. It is because due to the death of the insured, whatever the sum insured can be claimed, that is can be given to his nominee at the premature death of the insured. Okay va, provided the insured he has to pay the premium, that is the amount of the insured as a premium, either quarterly or monthly or lump sum according to the convenience of the insured. Okay va, so sometimes the insured also he may take a life insurance on the life of the spouse, that is those who are dependent on the insured. Okay well, now let us see what are the importance of the insurance. Why do we take insurance? Why do we take life insurance? Because actually life insurance it provides protection to the family at the premature death of the insured. One reason we can say. Sometimes it also provides as an investment, because after a certain period the amount can be given as a lump sum to the insured. So it is both as an investment and also a security to the insured, that is the compensation can be given to the dependents. That is the importance of life insurance. Now let us see the various types of life insurance policies. The various types is, first one is whole life policy. Okay, va? And then second one is endowment life policy. Okay, and then third one is joint life policy. And then fourth one is annuity policy. And the fifth one is children's endowment policy. Now let us see the first policy, whole life policy. Okay. Now let us see the explanation of the whole life policy. What is the meaning for the whole life policy means? Here the insured he has to pay the premium for the whole life of the insured. That means, for example, he must pay the premium regularly to the insurance company for 20 to 30 years. Here the insurance company it is under obligation to pay the compensation only after the death of the insured. Suppose if the insured after the fixed period is over, for example after 20 years or 30 years expires also, in that case the fixed amount is not paid to the insured. It is created only after the death of the insured. That means only the beneficiaries of the insured, that is only the nominees of the insured, a deceased person, that is after the death only the compensation will be paid to the insured. Next, we will see the endowment life policy. Under the endowment life policy, the insurer is liable to pay the sum assured to the after attaining a certain period or death, whichever is occurred earlier. Okay, va? Suppose in that case, the insured has to pay the premium regularly, either monthly or quarterly or half yearly, a lump sum also he can pay. In that case, after a certain period, suppose if the maturity comes means the sum assured is payable to the insured. Suppose if the death has happened unexpectedly means even the sum assured may be paid to the legal heirs of the insured, that is nominees of the insured. In that case, suppose for example after that whatever the premium paid, he will not be liable to pay the premium, that is the nominees of the insured will not pay the premium whatever the sum assured. For example, we can say for 5 lakhs, for rupees 5 lakhs, X has taken life insurance. So he is paying for example, he pays rupees 4,000 regularly for a certain period, that is for 15 years. Okay, ma? Suppose after 15 years, the 4,000, that is quarterly means yearly is paying 16,000. So 16,000 into 15 years they will calculate. Okay, va? That means for example assumption 2,40,000 it comes. In that case, suppose before 15 years, X died due to his illness. So sometimes unexpected accident may occur. In that case, whatever, because he has paid up to only 1 lakh only as the premium. In that case, the full amount of 5 lakhs is payable to the legal heirs of the insured, that is X. So that is the importance, that is the benefit of the endowment life policy. This will be taken as an investment also, or unexpected death may happen, means the sum assured will be payable to the nominees of the insured. Now let us see the next one, joint life policy. Actually, joint life policy is taken on jointly on the lives of 2 or more persons combined together. Okay, so this policy is taken mostly by the husband and wife together. But any one of the, either husband can pay the premium regularly, or any, so for example, even wife also can pay the premium regularly. So that is known as joint life policy. Suppose if one person dies, means automatically the remaining sum assured is payable to the survivor or the survived. Okay, now let us see the example. Here one is X and Y, husband and wife. They both together, they have taken a insurance policy of rupees 5 lakhs. In that case, X, he pays the premium for 5,000 regularly on the life of both the persons, that is X and Y. Unexpectedly, X dies. In that case, whatever the sum assured, that is the 5 lakhs, it may be paid to the Y, paid to the life of the Y, that is Y. So the sum assured 5 lakhs, it is payable to the wife, that is Y is eligible to get the sum assured. Whatever the premium already paid, she is not under obligation to pay the premium. Okay, only the actual sum assured 5 lakhs will be payable to Y. So that is the benefit of the joint life policy. So both the persons, one person is affected means by illness, or sometimes unexpected death occurs, means other person will not suffer by financially. So this compensation is given by the insurance company to the insured. Now let us see the next policy, annuity policy. Under this policy, the sum assured is payable either monthly or lump sum, likewise to the insurance company for a certain period. Say number of years, for example, mostly it will be payable to 15 to 20 years only. So in that case, the premium amount, they have that is the insured must pay the premium amount regularly. Only after attaining a certain period, for example, 20 years matures, only he will get the sum amount. For example, 10 lakhs means together with a bonus or whatever is applicable by the insurance company, it must be given to the insured. Okay, this policy is preferable only for those who are having regular income. In that case, they may pay the premium regularly to the insurance company for just like a investment. So suppose even if they get retires also, after that, suppose if they need money regularly, means this amount can be paid to the insured as a monthly installment to the insured. So the insured will not suffer financially after his retirement. That is the benefit of the policy, annuity policy. Next we'll see the children endowment policy. Actually, this policy is taken by the insured on the life of for the benefit of the children for future purposes. For example, we can say for education of the children, or suppose for the marriage of the children. Sometimes if they need money during that time, that time they can be compensated by the insurance company. Mostly, this insurance, for example, if a child attains the age of 1 year, means the insured, he may pay the premium on the child, that is on the life of his child. Only this insured, only he has to pay the premium on the life of the insured. For example, we can say Jeevan Anurag policy. These policies are meant only for the benefit of, that is, they are the children endowment policy. It is meant only for the children, either male or the female. Okay, suppose if he pays regularly after attaining, for example, he can pay the premium for 20 years or 15 years. For example, after 15 years, means this policy policy, that is the amount whatever he gets as sum assured, no, it can be used for the education purposes. Okay, wow. Suppose if he pays for a policy for the sum assured for 20 years, means this can be utilized for the marriage purposes, we can say. That is the benefit. That is, it is a type of investment taken by the insured on the for the benefit of their children. Suppose unexpectedly, if the insured dies, means whatever the premium payable, no, that is the children, that is the nominees, they are under no obligation to continue the policy. After that, the policy stops. That is, for example, 5 lakhs. Suppose if he has taken insurance on the benefit of, that is on the life of this child, in that case X dies unexpectedly, so whatever the premium amount payable is may be stopped, but the sum assured 5 lakhs, no, it will be payable only after the child attains the age of 15 years or 20 years. Okay, va? So that is the benefit applicable to the children. So the children endowment policy. So students, we have discussed the various types of the policies. Hope you have understood. We will see the next chapter in the next video.